And as soon as the DXY topped out, that's when gold and silver got this awesome bid. And so, in 2022, earlier in the year, we were seeing silver and gold go down with asset prices overall as the dollar went higher. And I think one of the things to take away from that is that even when the dollar was up 20%, gold was only down about 7% on the year. In normal markets, you should see a inverse correlation, meaning it should be dollar up 20, gold down 20. So the fact that you only saw it down 7 at its lowest point, to me, was a bullish indicator of big money buying in. And now we're starting to see the basic compilation of that, where gold and silver are both making nice moves up.
Do you now we've seen Powell, he did the 50 basis point rate hike. Do you believe this is it? Like, a lot of people are saying that he's gonna, even the Fed saying that they're gonna continue to be hawkish in 2023. Do you believe this is their last rate hike, or they're gonna continue?
So I think there'll be one more, and it's going to be 25 basis points. And I'm big on the symmetry of everything. So we started out with a 25, then a 50, then 475s in a row, then a 50. So it's kind of like coming down the opposite side of the mountain. And so It leaves us with one more rate hike of 25 basis points, probably early in 2023. I think the key here is understanding that when the Fed makes a statement, they have to remain extremely hawkish. If they show any sort of like wavering nature, the markets rip up. We then see, people feeling wealthier. You get the wealth effect because their stock portfolios are up, their asset portfolios go up, and therefore they spend more money, which then makes it harder for inflation to come down. So even if the Fed internally is saying, all right, we may only do one more hike, they have to act like they'll do 10 more just to keep the market in check.
Now, Gareth, CPI figures came out this month as of December 13th. What does that tell you, and where do you expect things to go into 2023?
Yeah, so we definitely saw the CPI number come in. We saw an initial rally in the markets, and then kind of the Fed slammed that right back down. And I think one of the things to keep in mind is that whenever you have high inflation, the first leg of reducing inflation is always the easiest, right? So going from 9% to, let's say, 5 or 4%, that's the part that's easy and quick. So I think, again, we'll be at 5 or 4 by, probably by the end of the first quarter of 2023. The problem is going to be that last little bit from, let's say, 4 back to 2. And my guess is we're going to really struggle to get that under control, which is then going to handcuff the Fed from being able to stimulate when we do go into a recession in 2023.
Where is Gareth putting his money right now with all the turmoil?
So I'm a big buyer of gold. I think buy it on pullbacks right now. And I think again, for me, it's shorting the S&P. We've already seen a big collapse just over the last few trading days. I'm not necessarily endorsing chasing it at this point, wait for a bounce, but then look to short it. I really do think that the S&P 500 is going to really struggle in 2023.
Now, Goldman Sachs, and many other banks, not just them, they came out this week and this past month, and they're laying off not just a couple hundred people, Gareth. They're laying off thousands of people, and a lot of them are from the mortgage sector. When you see that, what does that tell you? Is the recession already here?
Yeah, I think the big thing is that there's this lagging kind of recession aspect where the jobs numbers, right? So you had these companies it was so hard for them to find workers. They had to tried their best. They had to raise wages. And so now a lot of companies are very hesitant to lay off workers, but we're starting to see that change. We're starting to see these bigger firms, which have the ability to do more analysis on the labor market and future demand and recessions. They're starting to say, okay, listen, we are going to go into a recession here. We need to start laying off people. So I think this is a kind of a coming wave where you're seeing the big players like Goldman, Meta, these bigger players, they have the analysis and tools to see this coming. The smaller businesses, they haven't seen it yet. They're afraid to lay these people off just in case we don't hit a recession. And I think that'll be the next wave, probably later in 2023. So it's coming. The jobs numbers are always a lagging indicator. It's always kind of last to fall, but it is going to come, and it's going to be nasty, in my opinion.
Well said. Now, a lot of the major markets are in disarray, everything from crypto to even stock market. From where we are right now, Gareth, can you see another 20-30% drop in the S&P, or is the bleeding done?
No, so that's exactly what I'm projecting. So I think 2023 sees the S&P 500 down at least 25% from wherever we close at the end of December. And I think this is going to really be a year where the market comes to a reckoning that we've been addicted to Fed stimulus. Now the Fed, even if they want to stimulate, they're going to be too scared to, because the risks of kind of getting this hyperinflation going again. And the investing public is going to look to the Fed and say, hey, we're in a recession. Can't you guys print us out like you've done for the last 12, 15 years? And the Fed's going to say, sorry, guys, we still have 4% inflation. We can't risk that, because we might then see inflation jump to 20%. And then that kind of realization is going to make a major repricing in risk assets. And it's going to be, again, at least 25% down in 2023.